You were just vibing with your Bitcoin, maybe flipped a few NFTs, tried staking for the first time, and then bam! Someone drops the word taxes and suddenly the whole vibe shifts. Now you're wondering, wait, does the IRS even know about my dog-themed meme coins? Spoiler alert, yes. Yes, they do. Before you start panic selling your portfolio or googling move to El Salvador, let's take a breath. By the end of this video, you will know what taxes you actually owe, what's totally tax-free, and how to report it without losing your mind. Alright, before we get into the basics, let's talk about what's new for 2025, because the IRS just made things a bit more interesting. The new IRS Form 1099-DA. This year, exchanges are required to send out a brand new form called 1099-DA. It's like a report card for your crypto activity. It tells the IRS what you bought, sold, and how much you made. If you get one of these in your inbox, don't ignore it. Per wallet tracking. Another big change, the IRS now expects wallet-by-wallet reporting. That means you will need to track your gains and losses separately for each wallet or exchange. No more lumping everything together. Sounds annoying? It is. But it's important for accurate reporting. Want a full breakdown? We actually made an article diving into these 2025 changes in more detail. The link is in the description. Okay, so now the big question. What kind of taxes do you actually pay on crypto? There are two main types you need to know about. You will pay capital gains tax when you sell, trade, or spend your crypto and make a profit. So basically, anytime you get rid of your crypto and it's worth more than you bought it, the IRS wants a piece. Capital gains tax applies when you sell crypto for USD or any fiat currency, swap one crypto for another, for example ETH to SOL, use crypto to buy goods or services, for example buying a laptop with BTC, sell crypto that you receive from airdrop or activities like mining or staking. Here's how much you might owe depending on how long you held your crypto. If you held it for a year or less, it's short-term capital gains, and it's taxed like regular income anywhere between 10 to 37%. If you held it for longer than a year, that's long-term capital gains, and this is where it gets better. If your total income is under 48,000 for 25 or 47,000 in 2024 tax year, as single filer, you will pay 0% on long-term gains. And if you are married, filing jointly, the 0% tax rate goes up all the way to 96,000 in 25 and 94,000 for 24. So yep, holding your crypto longer could mean paying zero tax on the profits. Next up, income tax. And this kicks in when you earn crypto instead of just investing in it. You will pay income tax when you get paid in crypto for work or freelancing, earn staking or mining rewards, receive interest from lending or DeFi platforms, getting crypto from an airdrop, or receive new coins from a hard fork. Just like regular income, crypto income is taxed at 10 to 37% depending on how much you make in general. But here's some good news. There's a standard deduction. It's $15,000 if you are single and $30,000 if you're married and filing jointly. So if your total income, including crypto, stays under that amount, you won't owe any income tax. And here's an easy rule of thumb. If crypto comes in and you didn't pay for it, that's probably income. If crypto goes out and it made you money, that's probably capital gains. Okay, let's take a breath. Not everything you do with crypto is taxed. There are a few things that are totally tax-free, at least for now. If you are simply holding crypto, not selling, trading, or spending it, you don't owe any tax. You could be sitting on that Dogecoin stash for years. As long as you don't touch it, there's nothing to report. Moving crypto from Coinbase to your ledger, totally fine. Transferring from MetaMask to cold storage, no problem. As long as it's your own wallets and you are not selling or trading anything, it's not taxable. Giving crypto to your husband or wife, that's tax-free in the US. Plus, your spouse takes over your original cost basis if they decide to sell it later. If you donate your crypto to a qualified charity, you don't owe any tax on it. And you might even get a deduction. If you want more tips like these, including smart ways to legally reduce your crypto tax bill, check out our video Legal Ways to Avoid Crypto Taxes in the US. Alright, let's say you've done a few trades, maybe earned some crypto this year. How do you actually figure out how much tax you owe? Let's break it down in a way that won't make your head explode. For capital gains, it's all about profits. Capital gains tax is based on the difference between what you paid for your crypto and what you sold it for. Your cost basis is basically how much it originally cost you. Let's say you bought one Ethereum for $1,200. A few months later, you sell it for $2,000. Your profit, or your capital gain, is $800. That's the amount you will be taxed out. If you sell multiple times, your cost basis might change, especially if you're buying the same crypto over time. Most people use the FIFO method, first in, first out, to figure out the cost basis. For income, it's about the value when you receive it. If you earn crypto through staking, mining, or got paid in Bitcoin, you're taxed based on its fair market value in US dollar at the time you received it. So if you earned 0.01 Bitcoin when it's worth $400, you report $400 of income even if the price later crashes or pumps. Too much math? Don't worry. If this already sounds like a nightmare spreadsheet waiting to happen, you don't have to do it manually. Cointracking does the heavy lifting for you. Just import your wallets and exchange account and it automatically calculates your capital gains and losses, crypto income, cost basis and fair market values. And all this wrapped up in a neat report you can hand over to your accountant or upload to your tax return. So if you figured out your gains and your income, now let's talk about how to actually file your crypto taxes with the IRS. For capital gains and losses, you will have to consider two main forms. The form 8949, this is where you list every crypto transaction where you sold, traded or spent coins. You will include details like when you bought it, when you sold it, how much you paid, how much you made or lost. Cointracking actually creates this form for you automatically, which is a huge time saver. Schedule D. This is a summary of all the gains and losses from your form 8949. It gets attached to your main tax return. If you earn crypto like from mining, staking, airdrops or freelance work, it needs to be reported as income. Where you report it depends on how you got it. Common income forms. Schedule 1 for things like airdrops or staking rewards. Schedule C if you are self-employed or have a mining business. And of course, everything flows into your Form 1040, the main tax return. Don't forget the deadline. Tax deadline for the year 2024 is April 15, 2025. If you need more time, you can file for an extension, but that doesn't delay your payment due date. Now that you know how to file, let's talk about how to make the whole process easier for yourself. Keeping records is key. If you are doing more than just buying and holding, crypto tax can get messy fast. That's where tools like Cointracking come in. Cointracking helps you with imports your trades and transactions from wallets and exchanges, calculates your gains and losses, and tracks your crypto income from staking, mining or airdrops. It automatically creates tax reports and IRS forms and help you keep everything organized year after year. So instead of scrolling through hundreds of exchange emails, trying to figure out what you bought in May and so on, Cointracking just shows you. There are also legal ways to reduce your tax bill when it's time to cash out. Things like holding your crypto longer, using losses to offset gains, or even timing your sales strategically can make a big difference. I break it all down in our video how to minimize crypto taxes legally when you cash out. Check out the video in the description to save money. Crypto taxes can be confusing, especially if you're dealing with DeFi and NFTs or lots of trades in multiple wallets. So if you are unsure, talk to a tax professional who understands crypto. Cointracking even offers a full service options where their experts help with the whole process, so you don't have to stress at all. And that's it, you made it through the basics of crypto taxes in the US. Hopefully it all makes a little more sense now and you are not sweating every time someone says IRS. Thanks for watching, and if the video was helpful, drop a like and leave a comment if you've got questions, and subscribe for more crypto tips, and I will see you in the next video.